Everyone, welcome to today's session. Let's get underway here. Let me just open up one other here and we'll get rolling. There it is. Okay, let's first thing I want to go through, we're going to just go through kind of current market conditions, and we're dealing with kind of an interesting price pattern right here because we've been working on this buy sell ratio now for quite some time, really since the beginning of August, end of July. And we had this extreme level here on SPY. We had that three-part counter trend. I'll go in and look at that chart here with you in just a minute. But now we've got these two, the buys and the sells that are narrowing in. Remember that when these cross over, that gives us a buy sell ratio of 1. And that's what we want to have for bullish market conditions. Right now we're at a 0.34. So we really want to see that a little bit more solid. It's part of the reason why we're seeing a little bit of waffling right here. And let me pull in that SPY chart. It looked earlier, maybe an hour or so ago, like things wanted to rally, and they still may. We still could have a little bit of a retracement and see if we can close up above or inside of this zone. That would be the most ideal, the most bullish scenario. If we can't hold this range right here, then we're just slipping back this direction, and either it's going to be a deeper retracement and we just retest these lows here or somewhere in that range, or this is a new downtrend and we continue this overall downtrend. There's a lot of support at this location around this 429, 430 range before that ends up happening, before we really need to consider it that. It really looks bullish. This is really a classic bullish pattern right here. When we have our three-part counter trend, we have a support area, and it's right between that 50618 support range, and then we get a bounce, and then we get another smaller retest on that. This is as bullish of a pattern as you can possibly find, especially where we have about a 50% retracement of this high and this low. Right here, we've retraced right about halfway. So if we could close with a solid hammer type pattern, or really anything bullish right here, and try and get back up to the highs of the day, or close above that 431 on SPY, I think that would be constructively bullish right here at this location. Part of that analysis as well is focusing on what happens traditionally on this buy sell ratio. This is a really long time for it to be doing what it's doing, and if we go back even 3 years, you can see even in the heat of the bear market right here, this was the bearishness. This is really where it got extreme. So we have these upper extreme ranges, but you can see now how long this has gone in relation to this, and really this, if I were to draw a box around, really that amount of time, this was probably the longest. This was right around that bottom of October, and you can just see how wide that was. We really had these really wide ranges in November when we had these lows. So we're not getting that extreme, which we would expect. We don't want, when we're in uptrends or in bull markets, typically those retracements are not as extreme like they are here. So everything is measuring up for more upside right here, except for the economy and the bond market. So we've got bond yield curve, which is still flattening. We really want to see, and we really need to see bonds have a rally right here. So let's look at TLT, because we've got, see, even another day down today. This is it's just completely wacky right here. We haven't seen this in 40 years, and so it's just really unprecedented what's happening right here. The other side of that I like to show is this PFIX, because now you've got interest rates. This is the exact opposite view, where we've got interest rates that are at these highs, and bonds continuing to fall. We're getting close, if not today or within the next couple of days. It would be really, again, it's just unprecedented how far bonds have fallen. So we're getting definitely into that unsustainable zone, but markets can definitely create uncertainty and continue with an overall trend a lot longer than we may anticipate. So we'll see. You know, historically rates could go higher. We're only at 6, 7, 7.5%. And you know, in the 80s they were at 14, 15, 18%. So it's not like we can't get up into those upper ranges. I think it would just create complete and utter chaos in the market, and that's kind of what the Fed wants to do. My opinion is that the Fed has already gone too far, and in the next 3 or 4 months they're going to have to lower interest rates, and they're going to have to do it because the economy is going to be broken, and then they're going to have to rush to do it. So we may see the exact opposite thing happening right here, because we have this, oops, wrong chart, this price pattern on TLT. And if we go, let's go to a year perspective. And so, you know, we just have been accelerating this direction. These parabolic moves down they're not sustainable, just like parabolic moves up are not sustainable. When we start to see stock charts that look like this, you know what the outcome is going to be. It's never more upside. It's always some kind of nasty sell-off. So in this case, where we've gone the opposite direction here, it's going to create the most pain for the most people first, and then it's going to snap. So we'll watch to see if that ends up happening. I think the market is really muted right now because of that, and is not going to do anything until bonds start to move up again. That, I think that's really the main talking point right now among the equity markets, and really the bond market and the economy as a whole. Inflation, interest rates, those are kind of ruling. Now we've started this week with earnings, a new earnings season. So we'll see if we get any type of catalyst there that are going to propel things higher or lower. They could, if we see earnings and forecasts starting to show weakness, or guidance starting to show weakness, that could be a problem for the market. If we've got sectors, let's look at the sector ETF, kind of the grid on that, because this is also a good perspective on when we just sort these like this. We can kind of see that you've got 4 in the red, and you've got the rest in this hold. That hold is just that limbo. It's just it's just a trendless state. So now we've gone from, all being sell back to an uptrend. Now a handful are starting to tick back to the downside. This is not a healthy market right here. What we'd want to see is we want to see green across the board here. And we would at least want to see some of these starting to move back up into the bullish range. That being said, we're extreme in the shorter term on that daily chart. If I go back, still see if I have that chart. No, I don't. SPY here. We'll see if we continue to slide. But this, you can see why this counter trendy move, this consolidation, very corrective right here. But again, it could snap, and it could snap quickly. So we're kind of at a tough spot right here, where we're at a support area. We had a nice run up, we had a retracement. Now we definitely want to see some support higher. And again, just going back to that buy sell ratio, we're working in the right direction. This is a bullish type pattern here. Not to say that it couldn't do something that it hasn't done. Crazier things have happened, but it's now working its way this direction. The price pattern is bullish. What time is it? 12. We got 2 more hours. We'll see if we get a rally on SPY. The couple of other things to be aware of. When we're looking at so those sectors, we can also go in and look at commodities, because 2 of the commodities, gold is becoming one of the strongest commodities here, gold and silver, at 92 rank, and continuing to press higher with conviction. And so you could see market participants starting to realize, hey, the economy's slowing. Let's move over to a safer asset class. Let's move back into gold, and we'll see if that ends up being the case. I didn't mean to do that. Where did it go? There we go, gold. Let's look at oil, though, because oil is the other thing that is potentially going to create some issues with with price activity and inflation. When you have oil that's continuing to move high, it acts as just an excess tax on consumers, on businesses. When we're filling up our gas tanks and it's costing 20, 30, 40 bucks a week more than it typically does, then where's that money coming from, right? It's got to come from some other location, discretionary spending. This could continue to be a problem here if we see oil start to move higher and inflation not being under control, bond market sliding, interest rates skyrocketing, and if we get earnings that are bad, then that's kind of setting up for some potential downside here in the markets. The markets could have already anticipated that. Remember that markets are always looking forward 6 to 8 months. So the market in this downturn on SPY, is, this sell-off right here, and even the beginning, these two could have been looking far enough ahead. I don't know that probably this one was the beginning to see our current market environment, saying, okay, we're not going to be out of the woods. Now it's like we're there. This is where we're at. And so we could see markets rally because they're already looking 6 to 8 months, 9 months down the road from here, instead of looking here and saying this is where we're at. Markets are never looking at what's happening right now. It's always, unless it's new information that's not known. That's why you see even like Netflix today. Netflix had earnings, gapped up huge. I think it's up 15, 18% today, and that's the earnings were way above expectation. So the market didn't even anticipate that number to be so good. So as soon as they report that number, you get a massive spike. On the market as a whole, that happens. Let's look at that, because in 16%, so pretty nice gap up there today. So when we're looking at markets and they're moving forward and they're anticipating information, it's information that's known or anticipated. If that anticipated information is a surprise and all of a sudden it's like, wow, this number is way better than we thought, or it's way worse than we thought, that information is now available to market participants, and then they act on it. And this is what you get. You get a massive gap on a stock because the market didn't expect the earnings to be so good. It could be the same again with S&P 500, that wow, the economy is way better than we expected, or we get through this next 3, 4, 5 months and the market is saying, oh, that wasn't as bad as we thought, or wow, this is much worse than we thought. That's still up for grabs. That's kind of the market consensus, kind of the analysis currently on the market. Let's look at a couple portfolio ideas and some individual stock ideas. So the new buy list is pretty thin today. It's, sometimes you'll get days on real strong down days. That's pretty common. And even some of these, you've got gold, you've got oil, you've got a couple of retailers in there. Ross down here had a big move in the last couple of days. And we've talked about this in the past, where consumer staples and consumer discretionary have just been getting killed. Retail, though, has been picking back up. We're seeing Abercrombie and Fitch that's been doing well. Ross Stores is doing well. A lot of these discount retail stores are continuing to do well, where Dollar General has just gotten crushed. It's all over the place, and this market has really been a confusing, tough market, really for 18 months, and why things are doing what it's doing. But nonetheless, this is when it's working. We don't have to necessarily know why it's working. We just are focused on the fact that it is working, and let other big institutions start buying that, and then let us jump on board while they're doing that as well. So these some interesting price patterns here. Now, in portfolio management, this I wanted to get into one other strategy that we haven't talked about yet. Now, I'm doing two strategies here. I've got the new buy daily and the sell to buy. These are essentially just adding in the new buy no matter what the market conditions are. And we'll continue to track those, and some are going to get stopped out, some are going to continue to do well, some are going to, and we're kind of seeing that. This portfolio currently is kind of matching what the market is doing a little bit better, but it's relatively volatile. Down a couple percent is all. The sell to buy portfolio, again, I just started this one up last month, just so we can kind of go through and track that, getting some of those leaders that are starting to weaken. Now, one of the strategies to avoid that is to simply go to the buy sell ratio and only buy into a portfolio if green is on top. Okay, so if you're in an uptrend and you're buying muscle stocks or new buys, only doing it when you have a buy sell ratio that is greater than 1. It's a little more conservative strategy because you're going to go through a period of time where you're just not buying anything. And in a lot of cases, that's probably best, where you have these a bearish situation and we're moving lower. Let's just flat out sit it out and wait for one of these. So if you're continuing to build out your strategy on portfolio allocation and how you're adding into portfolios, and you want something, you know, and it would probably be the most prudent right here with equities being as volatile as they are, to say, I'm going to wait for this buy sell ratio to look like this before I start adding in. Now, that's just one method. That's just one approach, because we also want to be focusing on the width of that move as it's starting to take place. So we know that this was an extreme move. We also know that things are starting to move back together again. Could we anticipate? Could we be a little bit early to try and jump into that? Certainly, and that just depends on the strategy and the method that you want to focus on. If you just are like, I'm only going to buy high-ranked muscle stocks when the market is in a bull market, which it is still, it's just retracing, and buy-sell ratio is above 1. That's it. And then I'm focusing on my list. We've talked in the past few weeks about building out your own list instead of just using this new buy list to say, okay, I'm going to do, and we built out a list last week. I never did change the name of it, so we'll still use it. It actually pulls up 0 today. There's nothing in there that are meeting any of these criteria. So that also can make the portfolio management process easier, because you're only going to get a handful of stocks at certain times. You're going to get, because the scan is so tight, you may get 3 or 4 or 5 days in a row where there's nothing in there. And that's okay. In fact, that may be the best scenario. And there's all kinds of variations to be able to do that, and we've built out several. These are some examples where you have, 20 20 20 20 hold to buy. Obviously, you're not going to get anything there either, because this is pretty tight on that same setup. We set up a 5% dividend. With some of those criteria, nothing there either. We're just not finding very many stocks in those really tight scans. Let's see if we had any other, this top one here, 15. So this scan, I like this one. It's kind of a market cap driven. It's 2 billion market cap or higher. The volume is relatively light, and then I have just a PE of 1, and ROE, EPS, last quarter EPS, last quarter sales, all at 1. So it's pretty minimum. It's a pretty basic scan for just finding stocks that have earnings that don't have negative earnings. It's something in an uptrend that got positive earnings, and they're large cap stocks, 2 billion. So then that gives you this group from here. Obviously we've got some interesting names though. Oceaneering International, good looking pattern. Here, let me switch this over back to signals. We've got Adobe. Adobe actually looks like it wants to continue higher and possible breakout, and that's been a pretty volatile stock. Not too bad though. This run from June to August has been pretty orderly. It's a pretty expensive stock, and not expensive in terms of price or in terms of valuation, but expensive in terms of how much you got to buy per share, $558 per share. Sometimes that scares people away, but think of it, if you're allocating $500 at a $10 stock, or if you're allocating $500 on a $500 stock, it's just one share. It's still going to move. Percentages are still going to work the same. It's just sometimes it's just a mental thing for whatever reason. we don't want to buy a $500 stock, but we're okay buying, 10 shares of a $50 stock because we think that it's not going to move as much. A percentage move on 50 to 100 seems more realistic than 500 to 1,000. But that's not always the case. So building out some of those scans, some interesting names in there. You've got Google, you've got Motorola. They're a little bit lower on the rank, but really anything above 90, really anything above 80 is in that upper range. And because you do get so many volatile stocks that can have really big swings, sometimes those end up getting, all of the attention in that upper 90% range, but you may still have good quality stocks that are still growing and still increasing in price action, but they're not doing it as aggressively as some of these other stocks. But so their rank is based on the last 12 months versus the entire database. So you have you may have a stock. Let's look at one of these, an 86 rank ATR, and see. If we go the last 12 months, some volatility. You can see that volatility. When we get that volatility, and it's not just moving higher, it's a 30% year, only 15% year to date. That's not bad. But if we pull in a stock like TDW that's up 177% and 92%, that's obviously going to have a lot higher rank because it's just a lot stronger. The path of least resistance continues to be higher for those stocks. That's the methodology of momentum or trend following. Is we want this stock to be in this upper quarter of the chart. We don't want to necessarily be trying to have a stock that's going higher and then picking a bottom, and then it moves higher. That's not, there's nothing wrong with that. It's just a different method. And the reversal app on here also is kind of geared towards that strategy, because there's going to be a time where you get the uptrend, you get the counter trend, you want to start accumulating here, even like that S&P chart right now, but a little more confirmation and then a pullback and then a little more confirmation. Typically it's about right here in that price trend that things will start to get back up into that buy zone, up into that green buy zone. And instead of trying to go here, we want a little more confirmation and then let it continue to do its thing higher. It's because price activity is a visual activity on a chart. We sometimes confuse what is high and what is not. Okay, looking at this chart, I would say, okay, this is low and this is high. Well, yes, relative to that time frame. But if I were to just if I were to start here and I were to just get rid of all of this, and as if none of this has happened, and we're just working with this chart, I could say now this is low and this is high and this is a range, and it looks like it's going to continue to move higher. That's more of what I'm focused on versus saying, oh man, I'm not going to buy it because it went from 25 to 70. Versus thinking it went from 25 to 70 and it could go from 70 to 140 within that same overall uptrend. That's the simplistics of momentum or trend following. Is we're looking for something that's already proven itself. It's already working. There's already demand there. The fundamentals are good. These guys have a 560 EPS growth year over year, 100% over the last quarter. Something is working. And I've mentioned this a million times, and that is price activity. A stock price is the present value of the future earnings of a company, bottom line. But the price of the stock is the market's perspective of those future earnings. So because we don't know what those future earnings are, the market is going to guess. The market's going to anticipate, and they're going to be like, I think this company's doing well based on what they have been doing. It's going to continue to do well. And so I'm going to buy it right now, or it's done really well. I don't think it's going to do well. I'm going to sell it right now. Millions and millions and millions of market participants are making those decisions every second. And some of them are big heavy hitters, institutions and pension funds, hedge funds, insurance companies. Those guys, when they're making these decisions, it takes them months to accumulate a position, and they don't do it all at once. And it creates these nice overall uptrends on stocks that are quality names, that are quality companies. They're making money. The other strategy is buying buying a piece of crap company that you think is going to turn around, and it's been dropping and dropping and dropping, and then maybe it is going to turn around and recover. That's a harder game to play because it's not working. It's already moving down, and you can simply look at a price chart of something that is weak. In fact, if we go here and let's go to, there's this scan here called weaklings. Even if it only cuts off at 50, so it's only looking for stocks that are in a downtrend and a sell signal, and the rank is 50 or lower. So it's the bottom of the barrel stocks, and it's looking for crap so that you can continue to, so you can do something bearish with it, buy puts or be aware, hey, Johnson & Johnson, I own that stock. Maybe I shouldn't own it, right? At certain points. Right now, it maybe is a little bit extended this direction. But it's weak, and it's weak for a reason. It was weak here, and you think, well, I'm going to buy it. Oh, never mind. I'm going to buy it again. Oh, never mind. I'm going to buy it again. Oh, never mind. Right? You probably experienced some of that. I'm going to buy it here. Oh, I'm going to buy it here. I'm going to buy it here. And then finally, it's like, that wasn't working. Let's get out of that while things are moving down. If you're a super long-term investor and you're like, I don't care what Johnson & Johnson does, I'm going to buy it now because I'm not going to ever look at it for the next 30 years. And I think over time, it's going to increase in value. That's just a different game. That's a longer term strategy versus instead of buying a stock on the way down like this, we want to be buying it on its way up or as it's already working. This is obviously not working. Some investor now is going to come in and say, this is a value stock. I think that their value is worth a whole lot more because of, it's continuing to drop and the company's recovering, their earnings look good. So I'm going to buy it now at the absolute bottom. That is certainly a strategy that somebody could employ. And you could even use it here utilizing the software, but it's just not, it's kind of not geared for that. You could say, yeah, this is just like a bullish trend, this bearish trend. Now we're here. Here's our momentum zone. Here's the 236. It counter trends up. Here's our resistance, more downside. It moves back up, more downside. So you could do the same thing, but the other direction if you are looking for bearish strategies or ways to be able to profit on the downside or ways to be able to avoid stocks that that you don't want to be in. Okay. Let's see here. That was really what I wanted to focus on today as far as portfolio management, is continuing to look for methodologies and adding in that buy sell ratio if you want that additional structure to say, I'm not going to add any new stocks to any of my portfolios unless green is above red. Okay, if green's above red, then I will. If not, then I won't. Okay, and you can decide how that looks for the number of holdings you want to have. If it's a smaller portfolio and you don't want to have 20 or 30 holdings, you want less than that, then those stocks need to be a little bit more specific, and the market conditions need to be a little bit more specific as well. So we may be entering that timeline here in the shorter term if we can get a bounce on S&P 500. Let me see. Yeah, so let's watch that today. The remainder of the day on S&P 500. Watch to see if it bounces, if we can get back up and close, and buy sell ratio is continuing to work towards each other, so we can get that crossover. That could give us a little bump up here going into the next couple of months. But as of right now, there's still a little bit of weakness, and if we continue to slide and close lower. This has that feel though of when markets continually, they rally and then they retrace and you get that one day and you're like, okay, we're going bearish, and then you get a big solid bar to the upside, something like this where it's selling off and then it just immediately rockets back up again. This market kind of has that feel right here, and we should see in the next 2 or 3 days if we're going to get that bounce and close back up above that 430 range. That would be that would be good. That would be constructively bullish towards more upside. But in summary, market conditions, still weak, still sloppy, still in a bull market. This is just a pullback in this overall bull market. We're right at that 382 in the last year, and we're now stuck in this hold range. And that's just kind of that transition. Are we going to transition back into green like we did here, or and kind of like here, this kind of has that same feel to it. We've now moved to here. Are we going to move to here and then start some more upside? That's the phase that we're at right here. And some of the catalysts, it's all I think the two big ones are going to be bonds and interest rates and inflation, which may be oil or some of those other factors, but really it's that bond market that's got to rally, and interest rates have got to start to come back down for any kind of sustainable move in the market over the next few weeks, 6 to 8 weeks. I'm going to end on that note. Appreciate all your time and effort, and we'll see you on Tuesday. Thanks a lot. Bye now.